If you have a business that you're looking to sell, why is profit so important when it comes to the sell of your business, and why does it matter? This is a fantastic question. I'm Scott Sylvan, coming to you live from Consulting Secrets on a perfect day to talk about sales and business and selling a business, and a fantastic day to talk about you. I'm coming to you live from Haleiwa, Oahu. So one of the things that you're going to hear when it comes to selling a business is how much profit was in that. So there's a couple of different terms, and I'm going to share with you how you know which term that you can fall into, okay? So first is SDE, Seller's Discretionary Earnings, which means that if you were to leave you were going to go on vacation and you couldn't leave your business for more than a couple of weeks at a time, you probably don't have proper management in place. You probably have a lot of things that you're doing on your own. So that would be, hey, we're not running a professionally managed company where we could leave for months on end and be okay. EBITDA is going to be a professionally managed company. EBITDA is going to say, hey, I could leave my organization for 3 months and probably be okay. We've got standard operating procedures in place. We've got a management team in place, which, could be a general manager, could be an ops manager, whatever fancy terminology that you want to use. So today, I've got my whiteboard here with me, my $12 whiteboard, and I want to go over a couple of things. So first, we're going to talk SDE, Seller's Discretionary Earnings. So let's say that you have this company, a widget company, and you're making $1,000. We're going to use really easy math. We're making $1,000 a year in revenue with a 20% profit margin, which means we've got $200 to work with. In an SDE company, typically the max it's paid out is a 2x multiple. So they'll take profits for the year and say, we are going to multiply this times 1 or times 2. So the banks will refer that to as turns. How many turns are there? So we're going to say it's a one-time multiple for SDE. So we have to be able to pay back the loan, we have to pay taxes, and then the new owners want money. So we have $200 to work with. We're playing the budget game. So let's say $100 goes to the loan, $40 goes to taxes, and the owner says, I'll take 25 of that. We are at $165. So we have 165. Fantastic. 165 out of 200 is going to leave some room for things like marketing, and it's going to leave room for other items that we could do, bonuses, we could buy new equipment, or whatever it takes. Now, remember, we're using very simple math. Here's the thing. If you are looking to sell your business in the next 0 to 36 months, and your company's doing at least $2 million in revenue with a 10% profit margin, reach out to the Deal Hotline, 888-DEAL-919. And a member of my team will talk with you about what the possibilities are and how we could work together, right? 888-DEAL-919. No deal is too big, right? So we're going to change this up a little bit, and we're going to make some different numbers. We're going to switch this up, and we're going to say, hey, what if this company was professionally ran? And instead of a one-time multiple, we're going to switch it to a 3, okay? So we're going to put this to a 3 times multiple, which means we have to pay back $600. So because it was SD on the first example, we were only going to have to pay back 200. Now we're going to have to pay back 6, okay? So we got to figure out what the terms are going to be. So if we're going to pay back a loan at 6, let's say we have $200 a year to work with, we are going to pay $75 in the loan. We are going to pay $50 in taxes, and we are going to put $40 to the new owner. So 90, we're at $165 out of 200, okay? So 75 goes to the loan, 50 goes to taxes. These two numbers are going to be standard pretty much every year as the company stays, if it's going to stay the same number. So we got $75 going into 600. So we need to figure out, how do we get this loan paid off? Well, 75 times 2 is 150, 70 times 4 is 300. This would take an 8-year loan. It would be 8 years to pay that loan back. And so the owner of the business, which may be you, goes like, I'm not waiting 8 years to get paid on my money. Okay, cool. Well, law of price and terms says that we got to figure out how to make this money and this math work, okay? So I may come back and go, okay, so here's the thing. We're willing to pay $125. I'm going to buy your business. I'm willing to pay $125 a year, and I'm willing to take less money. Okay? And the reason I bring this up is I want to get this deal. So now we're at $195 out of 200 in profit. We still got 200 profit. We were going to say, hey, because of your EBITDA, we were going to multiply it times 3, which is 600. We got 600 right here. We got 600 right there. We're going to say we have $195 to work with. Could that deal absolutely work for me? Yeah, it could, right? If we go in and make the company more profitable, I'm not going in to buy a business, to purchase a business, to have it do less. I want the employees. I want the skills, the talents, and the capabilities that they bring to the table. I want them to be around for the long run, right? A good investor is going to come in and say, I want all of those people. I didn't buy a business to let people go. I didn't buy a business to lose it. And you're saying, hey, Scott, why is there a loan? Well, whether it's private equity or not, all that money is loaned, right? Most investors are not going to walk in with a pile of cash and say, hey, I want to buy your business. Even if it's private equity, a lot of times what happened was that was a pool of money that people said, hey, I want to get investment back. I want to get a percentage of return rate back. And sometimes it's 10%, sometimes it's 15, sometimes it's 0, sometimes it's negative depending upon the year. But be aware that profitability inside your business is a key indicator of what type of multiple or turn that you could get when it comes to making that sell. And a lot of times what happens is people will say, hey, look, I want to sell today. And then they meet with somebody like me or somebody in my team, and we take a look at the numbers, and there's not enough money in the deal. I can't pay for the loan. I can't pay for the taxes. I can't pay myself as a new owner. I may decide to take 0 for a while for that company to break even and move this money up on the loan and say I'm willing to pay more, okay? So just for straight math numbers, be aware that there's a lot of times where companies we take a look at are essentially not viable. So I took a look at a manufacturing company, and on the books, it showed that they were making money, but when we figured it out, they were losing a significant sum every year because of the way that accounting works. So know that it is your role and responsibility as an owner or a proprietor to make as much profit as possible, to make as much money as possible, so that when you go to sell your company, that's very attractive. The most profitable companies are the ones that are all the way at the top, right? My dream company, profitable company with little problems, right? I don't have to go in and replace a bunch of stuff. I don't have to fix a bunch of things. That day one, I could walk in, I could put somebody in place to run that thing, and it's smooth sailing. Worst case scenario is to go and do a fix and flip where there's a bunch of stuff wrong. It needs a new team. It needs new people. That's a lot of work. It's a lot of work. So the reward has to be bigger. It's risk versus reward. There you go. If you got a company that you're looking to sell in the next 0 to 36 months and you want some help, you should absolutely reach out to the Deal Hotline, 888-DEAL-919. $2 million a year in revenue and at least a 10% profit margin. No deal is too big. Looking forward to connecting with you. Aloha and mahalo.